So great. So today, rather this morning, we will be looking at the International Accounting Standard number 12. So as you will have seen, the standard is called income taxes. And what the standard really does is that it says you tax experts, you have learned your tax, and you know what you want to pay your tax authorities. But what we are interested in is that how do you tell that story to your investors in the financial statements? Because investors have come to understand that each and every business that will give them a return, it will be subjected to tax, regardless of what, regardless of where it is. And as you can imagine, the principles in this standard, because this is an international standard. Oh, also no, sorry, I see, I didn't see you there. How are you?
I'm good, Mr. Radane. How are you?
I'm good, Are you well?
Yeah, I'm well. It's just, yeah, I think my colleagues have covered most of I've got the same issue that they have in terms of time to grasp the concepts, given that I didn't even do the BCom. So I think my struggle was also to go through the standards. How do you go through the sections? Yeah, I think that was also another concern. But I think when we get to next year, I will be able to do all that, because my concern was that in terms of the question and answering, I think also what I would also look at when I'm reading or when I'm studying, I would be like, okay, how will I be able to deal with this in an APC exam? How will I be expected to page through what, and what standards will be required for me to go through? Will I even have the time? So I think that was a concern. But I think also you've shared that once you get to the preparation of the APC, we'll be able to now be in a comfortable position on what to look out for, and also with the pre-released material that will enable us to maybe to just give us a view of which specific standards might be asked during the exam.
Mm,
Yeah.
yeah, yeah. But I promise you're gonna love it when we get there. I promise. All
Yeah,
right.
surely.
Sure. Thank you. Let me just share just the high level. Yes. So as I was saying, so this is the operative standard, IS 12 income taxes. So as I was saying, that the other thing we need to be mindful of is that this is an international standard. This is not a South African standard. This is not a Zim standard or any country-specific standard. So the reason I want you to appreciate that is because it, it recognizes, or it's able to apply these principles whether your government is on a resident, or was it a source-based approach, or a resident-based approach, or whether your government or revenue authority has got a deduction for this or that, and so on and so on. So that's why I said even this morning that for us, and when you approach here, you don't need to understand IS 12 to know the specific aspects of tax. You just need to appreciate how tax works. And therefore, you will then be able to see the difference. And what we're going to do today is that we are going to be making assumptions about how the Tax Act works. So whether you've got the South African tax legislation with you, or whether you've got the Zim legislation or anywhere else legislation, it will not necessarily matter. What will matter will be the understanding that from a SARS perspective, or sorry, from a tax perspective, when you acquire an asset, you don't depreciate, you get wear and tear allowances. So those are some of the things that I want you to just start off with. So if you are saying that, sure, tax journey has been a little bit rough, that as much as it may be, it should not impact how you do it. It should not impact how we then deal and unpack IS 12. And the other thing about it is that what I then gave you, it's last year's ITC exam. So the ITC exam is what it now takes the integration to the next level. So when I say integration to the next level is that you might find when you're doing that particular paper that they might not give you the tax treatment of specific item because they're saying to the ITC candidates that you, when you were preparing for ITC, you studied tax. So you need to know them and you need to be able to reverse those tax effects so that you can put through the accounting effects or vice versa, take out the accounting effects and put through the tax effects. So that is the idea right there. That for our discussion, you don't need to have your legislation with you. We are going to assume tax. So I might just tell you that we have acquired an asset and the deductions are these. So if now you know that, no, but Renani, this is new and unused, or Renani, this is the least asset, this is so on and so on. So for now, we are not going to be what? We are not going to get into the detail. We are just going to appreciate that there will be a difference between how the tax authority are going to treat with this payment, with this receipt, versus how, from an accounting, we're going to deal with it. And remember that most tax authority works on the area of invoice or receipt, meaning that if now you pay for an expense, you are likely to get a deduction whether you have received the services from the supplier or not. So they recognize that particular aspect, that you have now incurred a cost towards something that is what? That is going to support the generation of income. But accounting is then founded on the principles of accrual. So accrual basis says that we don't necessarily care about the payment. We care about whether there has been, excuse me, there has been what? An incurrence of an expenditure or an entitlement to a receipt. So that is the first thing that you need to what? You need to understand about how the tax authorities think like, as well as how we as the accountants think like. So we are now going to say, so what? So if now I am to take my financials and I'm to present them to my investors, and I say, guys, this is what then happened during the year. We signed up as, maybe let's use Vodacom. We signed up as so many contracts this year. So these contracts, people came, and when these people came, they then got the new iPhone 16. And when they got the new iPhone 16, we gave them the device and we told them we're going to give them so much data, so much minutes on a monthly basis for the next 3 years. And then SARS is saying that, oh, I see that you've entered into a contract. Now we're going to be saying that what will then SARS demand from you after you've entered such a contract? And now that we know that that contract will be in terms of IFRS 15, what will IFRS 15 want you to put in the P&L? And this is now where it gets interesting. Because IFRS, sorry, not 16, 15. IFRS 15 will then tell you what is your performance obligation, blah, blah, blah. And it will then say, if this is your performance obligation, how much has been fulfilled? Recognize revenue as X. But SARS might then go on the other way and say, now that you've entered this contract, these provisions are going to be applicable, and therefore we're going to tax you like this. And when you come to your financials, you will need to then talk to your investors to say, guys, you saw that I reported revenue of 100,000. The tax effects of that 100,000 is X. Or you are expecting, if there are no any expenses, 100,000 times 25% or times 27%. So now, if that is the case, we'll then say, that's interesting. So we are just expecting that revenue multiplied by the tax rate applicable. However, the tax authority might come and say, oh, in that 100,000, since there's this and that, we are only going to tax 50,000 now, and we're going to tax the other 50,000 later on. So now this brings a little bit of a tricky situation, that in reality, the tax I have to pay is only 50% of the revenue I'm showing my investors. But my investors are saying that since you showed us revenue of 100, we are expecting tax of 100 times your tax rate. So the idea there is we need something in between to come and explain why the investors are expecting something, but it's not the reality. Because when we now report on our tax obligation, we're going to say 100,000 times 50% times our tax rate. But investors will be sitting there and say, wait, am I in a business that is robbing the tax authorities? Because it's showing revenue of 100, but only has tax for half of that amount. What happened? So that's where accounting comes in, because accounting has to reflect the story in P&L in the tax number. And if that story cannot be reconciled, then accounting has to give us guidance on how we explain that to our investors, to say that, guys, the reason why you wanted to see 100,000 times our tax rate and you're only seeing half of the amount is because of this. So that is going to be our focus. We are going to explain to the users, to demonstrate to the users of the financial statements how we are deriving our tax. And in the instance where the tax that we are showing them, it's not what they expect, we have to give them a basis as to why. So that's it, what we are here to do. This is what this standard is all about. It wants to, because if this standard was not there, it means every entity out there will then just be taking the revenue based on IFRS, and it will then show the tax based on its tax authority, which would be very confusing. To say that if I'm holding the financial statements of a company, exactly the same company with exactly the same revenue in Zim and in South Africa, I might find that they are reporting different net profit, and I will not know whether that net profit is simply a matter of the tax rate just being different, or there are other aspects if this standard doesn't exist. So this standard therefore helps us to say that if you're looking at two exact company from a profit before perspective in different countries and their tax bill, you should be able to understand why the tax bill is not simply the profit multiplied by the tax rate, and that it will not be easy to then achieve that comparability. It will not be easy to just understand whether a company is fudging the numbers or not. So after we are done with this standard, you will be really that kind of expert. When you look at the tax expert nowadays, you will not look at it the same way. You will then have profit before tax multiplied by 27% if in South Africa, or 25% if you're in Zim, and you're going to take a step back that if it's not equal, then I need to be able to explain it from an accounting perspective, but using my understanding of what? The tax legislation. So we're going to introduce some terminology that are very specific to this particular standard. And those terminology wants to just align what we do in tax as well as what we're going to be doing now. So let's just talk or consider what the objective of the standard. And when it comes to the objective, I want you to go back to where we started the journey. So let's see. They say the objective of the standard is to prescribe the accounting treatment for income taxes. So that is the first thing that you will want to highlight. Why is that important for your purposes? Because you now know that there are different taxes that you deal with. You know that there are donations taxes. There's what there is estate taxes or estate duty, and so on and so on. Dividends tax is also there. Security tax is also there. Transfer duties as part of another tax there. Value added tax is there. But this standard does not deal with those taxes. This standard deals with income taxes, meaning our primary statement will be what? Will be the P&L statement. Okay. Then it says the principal issue. Let's hear. Why are we here? That's what we are now wondering. The principal issue in accounting for income taxes is how to account for current and future tax consequences. So now this is what I was saying about some of the things that are very specific in the standard. What do I mean when I say, or what do they mean when they say current and future tax consequences? I thought when I'm now working, generating income, contributing to my retirement fund, then there's what? Then there is tax that I need to pay. That's the story. But now this is saying that, but there's another story called future tax consequences. And I'm sure for those that have now started tapping into the two-pot, they are knowing that the current tax are going to be what? Recovered later on, right? So that is the thing. A deduction from a SARS perspective, it does what? It allows you to not pay tax now, and it defers it later. So that's what people are finding out with this two-pot from what I'm hearing and listening on the radio. So it's a very interesting conversation. But I'm sure you guys now appreciate how this all works. That when you are working, you get your salary, and then your retirement contributions are deducted such that you pay lower tax now. Because SARS is saying that I'll deal with you later on. When you now get this retirement, I've got a way to tax it. So do you see this current and future tax? That's how this works. So this standard here, that's what we are interested in. That whatever we are doing now, it has current tax consequences, and there's going to be future tax consequences. So we have to account for those. But you might be saying, why? Because SARS does not necessarily, or the tax authority, don't talk to me about the future. They only deal with things the now. They want their tax now. So the reason for that is that we apply the accrual basis. So this is why it becomes so critical how accounting works. In accounting, if you know that you have gotten yourself into something that you cannot get out of without this being a reality, accounting says recognize the tax consequences. So let's talk about that. So now, if you then enter into a contract to build a building, and the government, or a mine, and the government says that after you have mined this place, you need to rehabilitate it. So if now you have now dug a hole, it's an open cast, you have now dug that thing out, you have now operated. The fact that you have now entered as part of your mining license and into an obligation to rehabilitate that land, you recognize the liability to rehabilitate that land at the end of what? At the end of life of the mine. Even if that is an obligation, you're going to recognize what in 20 years' time, 30 years' time, and so on. So that's accounting. It does not wait until you get to that point where you now say that, oh, guys, I'm done. I think this thing will cost me 100 million to rehabilitate. Can I recognize my liability? Accounting will say, because now you have gotten yourself into a situation that you cannot exit without that obligation having been fulfilled. Recognize the effects of that obligation now. So that's where we now start to have an issue. To say that if you are required by accounting to recognize the future consequences of the action arising from the actions you've taken now, that means if you know very well that you've entered into a transaction that will result in future tax consequences, you should recognize those tax consequences now. That's what it's saying. And that's why it considers both the current and the what? And the future tax consequences. But we're still going to talk about where those tax consequences are coming from, because you will say, but is that not a very complex exercise? Linda,
Sorry,
please go ahead.
London.
Yes, sure.
So basically, you want to know the state of affairs of your business now, your financial position now.
Yes. But taking into account the decisions that you've already made now.
Yeah,
So,
because as a result of your
yeah.
consequences or the consequences of your operations or events that
Yes.
have taken place, so
Yes.
you've got an obligation now. If you were
Yes.
to stop the business now, you will have actually to pay that amount.
Yes.
Okay, thanks.
So that logic extends to income taxes. That if now you have acquired something that you know the tax authority will want it later on, you're gonna get it. So the same thing with the two-pot as well. You know that you are going to pay this at your retirement, this tax at your retirement, but you are now what? You are now transacting now. So you can't avoid it. Whether you take the money now out now or you take it later, there's going to be a tax consequence, because by virtue of having contributed and gotten a deduction in the past, you can no longer avoid that tax consequence. So what we are saying is that if you were applying IS 12, we will want you to recognize the tax obligation of withdrawing from your retirement Whether you withdraw now or you withdraw later, we want to see it because you can't avoid it. Even if for one reason or the other you decide to say, I'm just going to exit life, SARS will say, no, you've exited. We want in your estate that tax benefit that we gave you in the past. So there is no avoidable way of escaping that tax liability. And because there isn't, this standard says recognize that liability now. Does that make sense? What we are going to get to. Linda, yes.
Oh, sorry, I meant to say yes, Sharp.
Oh, okay, sure. So that's what IS12 it's all about. So let's just then go back and talk a little bit more about that. It says the future and the current tax consequence of future recovery of the carrying amount of the assets or the settlement of liability that are what? That are recognized in your statement of financial position. And we know now that everything in our statement of financial position has got what? Everything in our statement of financial position has got a past event. You entered into a transaction to create that liability or to create that asset. That we now know. It might have been in terms of IS 16, if it's 15, but we know there was a past event. So your doing, your incurring is now sorted. Now the question is that, all right, this thing you're going to recover. When you recover it, you're going to have tax consequences. Now, let's just talk about this. Let's talk about this because this is a very interesting point. So you will remember that when we started our journey, we spoke about how assets represent the future economic benefits embodied in an asset. So we then said that economically speaking, no business will know very well that if they buy this asset, they're going to make 100,000, that it will be willing to pay more than 100,000 for that asset. Economically, no manager should do that. So managers therefore buy assets that they believe that they are going to generate at least the cost of that asset. In finance, we know we're going to tell them, no, don't focus on generating the cost of that asset, but generate the cost plus a return in the form of work and so on. But that's how management thinks. So management are going to only buy assets if the economic benefits embodied in that asset exceeds the cost of that asset. And the moment they stop believing that, the standard says your asset might be impaired. So write it down to whatever you expect to recover. And that's why for impairment, we call that a recoverable amount. Now, this standard then talks or uses the word recovery. So I wanted to just take you back there so that you understand what does it mean when you say recovery. So when you've got an asset of 100,000 and you are using it to generate now revenue, to produce inventory, to sell that asset, the standard refers to that as a process of recovering the asset. So it then says, when you recover an asset, what are the future tax consequences? What are the current tax consequences when you recover this asset? So let's understand this terminology, because as I'm saying, it's used and you're going to see it probably here in the standard. So now this becomes very interesting. So now when I go buy an asset, the tax authority and accounting. So accounting will then say what? Will then say, that is an asset which has got more than a benefit for 12 months. So capitalize it in terms of IS 12. All right, we know debit PPE asset, credit bank. Great. Then SaaS, you acquire it. You've got a different what? A perspective. They'll ask you, is it capital? Is it so on and so on? And let's just assume that we agree that this asset from a tax perspective, it is a capital asset, meaning that when you acquired it, you didn't get any deduction. But we know that when an asset is acquired, you then are entitled to what? You then are entitled to what we call allowances. So now what we are saying is that when you recover that asset, how do I recover a PPE asset, a machine? I recover the benefits embodied in it when I use it. When I manufacture items, when I sell it, that's when I'm recovering the economic benefits embodied in the asset. Okay? So now, when I recover and therefore use the asset, generate economic benefits, what are the tax effects or consequences? This then says that, or the tax authority will then say, I will give you a deduction, or I'll give you a wear and tear allowance. I might give it to you in 1 year if you meet some criteria, or I might give it to you over 3 years, 4 years, depending on what I have established as the tax authority. But upon recovery, you are going to have your taxable income reduced. Okay, so that is the context. Then we are also going to do transactions and other events for the current period that are recognized now not in P&L, not in SFP, but recognized in the financial statements. And that can include P&L. So we are interested in recognizing the income tax effects or consequences in our books arising from this. So one of the things to note from here is that we are dealing with assets and liabilities recognized in the statement of P&L, of a financial statement of financial position. So when you read some textbooks, they will tell you that they apply what they call the financial position, the statement of financial position method, or otherwise previously known as the balance sheet method. If you ask them why, they're saying that's because the standard thinks about it from assets and liability perspective. Right? Then let's just use an example to explain some of this terminology. So let me open my Excel. So if I then say A Limited was recently incorporated, the owners contributed capital. The owners contributed capital of 100,000. This capital was used to purchase a machine for, let's say, 80,000. Management believe the following about the company, that that in current year, the revenue will be 60,000. And in future years, the revenues will be 150,000. So that's what management believed. That's why they were willing to put their money here. So that's why they were willing to put their money here. All right. Then the machine acquired will be used to generate that revenue. Then the machine has a useful life of 5 years. The tax authority grants wear and tear over 4 years. Then expenses, current year and future years. So current year, let's simplify it and say 15,000, and future years, let's say 45,000. All right, so we are here. We have this. So let's then say tax rate, it is simply 30%. So we have this scenario right here. We have this scenario right here. So now let's just talk about what I was saying before. What I was saying before is, if we then assume that this expectation and this reality was a reality that management experienced, then one will then say that what is the P&L in the current year and in the future years? So in the current year, do you agree with me? Revenue will be 60,000, right? Then we'll have depreciation. They depreciate the asset over the useful life of what? 5 years. So 80,000 divided by what? Divide by 5. That's 16,000. Okay. Then other expenses.
And then why are we using 80,000?
The purchase.
The capital. Yeah. Okay, got
yes,
it.
Yes.
Okay.
Sure. So other expenses becomes this 15,000. So our profit before tax becomes what? Becomes 29,000. So far, so good. Okay. So now, if the tax rate is 30%, then one will expect tax to be 30% of 29,000. And my profit after tax will then be what? Will then be 28. So do you agree that if you are an investor, this is what you are expecting the P&L to look like. If you are not aware of what? You are not aware of IS 12. All right. Now, let's talk about the future years. The future years. So the future years, it's up until whenever you can think about it. Remember, companies are going concern, so we assume that they will live or they will run forever. So the revenue in this forever story of this company, it's 150,000. And do you agree that in forever, this asset will then be used up for the remaining useful life of 4 years? Do you agree? Remember that 5? So that means the other 4 are in future. So that means we now have 64,000, meaning the depreciation of 16,000 in the current year and 64 in future years. Then other expenses will then be what? Will then be 45,000. And profit before tax is 41, and tax is 30, and profit after tax is this. Are we comfortable with what we just did? So simple calculation of profit or loss. Happy? All right,
Okay.
great.
Yes, happy.
I just wanted to find out, when you say future revenue is 150,000, you mean for the rest of per year or for the rest of the asset?
For the rest of the asset, the rest of the
Okay.
company, yes.
All right.
Yeah. Okay. So we've got this picture. So this is what we are expecting from a current tax. So from our knowledge, so let's call it accounting basis. All right. This is our expectation. But now SARS, remember SARS, we don't care much about them preparing our P&L, but we care about them preparing our tax bill. So we want to know the tax bill that we've calculated, is it actually the one that we'll be paying? Because it would be weird to tell investors that our tax is 8.7, but SARS or the tax authority wants more or less from us. So what will the tax authority want from us? So let's just do that picture. So I'm going to call this taxation basis. So revenue, they see 60,000, but they don't have depreciation. They have wear and tear allowance. And in the wear and tear allowance, what do they have? They then have 80,000, the same cost, but they divide by 4, meaning that they allowed 20,000 in year 1. And what has it done? It has changed the tax that we are paying. Now, let's think about that. So, okay, yeah, we're going to come back to it, but let's keep this thinking. Then now, for this, they now have wear and tear in future for the remaining 3 years. Do you agree?
Yes.
So we now have 60,000. Then the tax has now what? The tax has also changed. So this is the picture in terms of what? In terms of the tax basis. That's what the tax authority will send us the bill for. They will send us a bill of 7,500 in the current year, and in future, they will send us a bill of 13,500. So now we sit here and we are confused. So which number do we show our investors? Is it right to show our investors the 8.7? Or should we be showing our investor our true obligation of 7.5? And in future, what should we show our investors? 12.3 or 13.5? What is your initial, let's call it guess? What makes sense for you as an investor? What do you want to see? Are you happy with the accounting basis? Or you are saying, no, in reality, because tax is only 7.5, show me the 7.5. What do you want as an investor sitting now looking at these numbers? Do you think that the accounting is capturing this picture accurately? Oh, but remember that you have already accepted accounting that it doesn't work on cash. That accounting works on accrual basis. You have accepted that, and this is how it works. So now with this picture, are you happy with this reality? And if you're happy, you could just say, yes, I'm happy, but maybe give me some narrative to see the impact of this. But where is your mind now?
I want to see the true tax that is payable to SARS, meaning the 7,500 needs to be reflected in the first year and the 13,000 in the future years.
All right. And your basis will be what? Why will you want to see that?
Because it will be the true reflection of the tax payable to the tax authority.
Okay, so the tax payable to the tax authority. All right, fair enough. Sure. Everybody agreeing with Helen's view, or someone has got a different view?
Okay. I would say you need to show the actual obligation that you have in your balance sheet. And then, yes, in your balance sheet, basically, there are two things here.
Yes.
You've got the actual obligation on the accrual basis of accounting.
Yeah.
And then you've got the amount that you have actually paid based on your bill that you are getting from SARS.
Yeah.
So now what you need to do, you need to show the actual obligation in your statement of financial position. And then you need to show the 7,500 that you have paid in terms of SARS to say, okay, this is my in the balance sheet, my obligation will be the 8.7 versus in the income statement the 7.5. And then now that is when you need to tell the story, as you were saying, to say, why are the investors expecting the 8.7, but you are showing the 7.5?
All right, sure. So and that's it. That we if we are applying the accrual basis, it's like we should have a tax based on the accrual basis. So the tax should be on the accrual basis. It should not be on what? Now on the cash basis. But the cash cannot be ignored. I think that's what we are now agreeing. All right, let's keep that and see if we can explain this to the users. Now, can we do the difference? So let's do the difference of tax in year one in the current year. So I then say it's 8.7 minus what? Minus 7.5. All right, then in future, I find it's 12.3 minus. Oh, so now this becomes interesting. So I am finding now that I am paying less tax now, but I'm going to pay more tax in the future. Based on what this is saying, do you see that? So or maybe because it has to be in comparison. So I am paying less tax than what I wanted to pay or I had expected to pay. I had expected to pay 8.7, but the tax authority sent me a bill for 7.5. So I'm paying less than what I expected. In future, I will then pay more than what I expected. Did you see this, what these numbers are saying? Because this is now the core. So after this, we are essentially done with the lecture today. So this right here is the core. We are paying, we are expecting to pay 8.7, but we are paying 7.5. In future, we expect to pay 12.3, but we're going to pay 13.5. So in future, we expect to pay more tax than what we expect. Currently, we are getting some kind of a deduction and paying lower tax than what we expect. However, it is as if the 1.2 that we wanted to pay has been what? Has been deferred into the future. And that's where the concept of deferred taxes come from. It is as if the 1.2 that we are saving now, we are doing what? We are deferring it into the future. Do you see this? Helen, yes.
Okay. Yeah, no, I think, yes, I do understand like the deferral part, but
Yes.
I just wanted clarity, like on your statement of comprehensive income, P&L.
Yeah.
What amount will be reflected on that phase? Is it the
We're gonna get to
7.5
that.
or?
We're
Okay.
gonna get to that. Yes.
All right.
Sure. So these are the building blocks where you're gonna say, oh yes, because as an investor, you have to understand. And if you are working for the investor, you have to be able to explain to them. So however way you will find yourself. But do you see now the concept of deferred taxes, where it comes from? Whatever we expected to pay now is being deferred into the future. And what I was saying before is because this deferral is coming from the fact that you have acquired this asset and the tax authority has told you they're going to give you a deduction. In other words, the moment you acquired that asset, the tax authority, by their legislation, they are obliged to give you this allowance. They cannot withhold them. It's not theirs to choose on to withhold or not to withhold. You can refer to the Tax Act and say, the Tax Act says that if I buy this asset, it will qualify as a capital asset, and there is a tax provision that the authorities have approved and said that I will then be allowed to deduct this. So now, what I said before was that if you know that in future you're going to pay more taxes, then you have to recognize a liability now. So yes, we recognize a liability, which we are calling a deferred tax liability. And this deferred tax liability, it is going to be 1.2. That is my liability. But if I say that I'm going to have a liability, what should I have on the other side? Will it be an income or an expense? What will it be? If I'm going to have a liability, will I have on the debit an expense or an income item? What do you think I will have?
An expense.
It's an expense.
It will be an expense. Thank you. So we will then have the income tax expense of 1.2. So this is a deferred tax income, the deferred income tax expense. So from an accounting perspective, we are saying that we're going to have what we call current tax, which is based on the tax authority of 7.5. Then accounting is going to say we are deferring some tax of how much? Of 1.2. So the tax expense for the year will be how much? Surprise, surprise, it's 8.7. Do we see the magic in accounting? It's always amazing, this thing.
So I would like to ask,
Yes, please.
when you're preparing these financial statements, at first you'll be having the 8.7 coming from the accounting side. And from the explanations we are going through, the taxation basis will come after the assessment from the SARS side. That's when we have this the obligation that we are supposed to pay to SARS. So my question is just a matter of like an arrangement whereby we have started with the tax obligation from the tax authority, but I'm an accountant who is preparing the accounts. I have the tax obligation based on accrual basis. Yeah, before taking into account the issue that I have seen where the difference is coming from, which is depreciation and the wear and tear. Assuming that I don't have that knowledge, I only have information on my accounting financial statement. How do I know this the value of the tax, the obligation from the tax authority before being provided the information with the SARS?
Go, great. I hear your question. So it's like a process kind of question that how do we do this in practice? Because even if you think about the timing, most tax authority, what they do is that if my year end is today, they give me up until the end of today next year to submit my obligation for the current year. So the reason why you have to go through tax as a discipline in your journey is because you need to do this calculation for your tax authority using their legislation. And you will then put it on your books. And what we call that your estimated tax. Then your tax authority will then assess you and give you an assessed tax. When now there might be a difference between what you had originally assessed and what you are actually assessed. And when they assess you, they will then issue you with say, oh, Vingarai, we saw that when you calculated and paid us, you had estimated that you will pay more tax, but our calculation is leading to lower tax. Here's some of your money back. Or you, when you estimated your tax, you gave yourself some deduction that in terms of our legislation, you should not have gotten them. So we took those away. So you actually owe us a little bit more. So can you pay us this more? So that's what happens. So think about it like a payee. Like during now, we are busy paying payee. Or we've paid payee for the 2020, where are we now? 2023, 2024 year, which ended, say, in Feb. And now we need to file before the end of November. Then that's where now some people say, I'm expecting a refund. So why are you expecting a refund? Because when your employer was calculating tax on your behalf, they were paying some of the tax on your behalf. But now the tax authority are assessing you and saying that, oh, your employer missed some things about how we do things. So you have to pay more tax. Oh, we now owe you. Here's some of your money back. Or maybe the authority didn't know something that you know. And therefore, when they started assessing them, then that's what that happened. So that's what happens in practice. So it's exactly like payee. The company pays something towards that. So that's what we call a provisional tax. So they pay something towards that. Then the tax authority assesses you, which they can have a higher or a lower number than the 7.5, and you will then need to adjust the liability to the tax authority accordingly. So that's how it happens. So it means that every time you open financial statements, that is not an assessed tax. That is an estimated tax by the accounting team or the tax team, depending on how big the organization is. Does that make sense, Pingarai?
Yes, thank you very much.
Sure. Right, I see two hands. Linda, go for it.
Okay, so you've got two types of liabilities here, or maybe it can be a liability and an asset. You've got the current tax, which is the tax authorities, and then your liability according to the accounting standards, which is it can be a liability or an asset. Now this, you have to tell two stories here to say the first one, why do you deviate from what is in your income statement, the 8.7 versus the tax authority? So that will be your reconciliation, basically telling your investors. And then the second one will be actually your deferred tax story. And then you will have the total view now of your tax liability according to accounting. Am I right?
Yeah, but it needs to be, there needs to be like some kind of a provision or a caveat to that. So, and you're gonna see it later. So here we've got what we call a temporary difference. So this temporary difference is to say to our investors that, guys, the reason why there is a difference is because this is a temporary thing. I'm either deducting too little now and I'm going to deduct more later, or I'm deducting too much now and I'm going to deduct little later, or SARS is deducting. But what we are just saying is that it's temporary. So if it's temporary, then just know it's gonna sort itself out. Whatever you expect will be exactly that's what I calculate. And the difference between what SARS or the tax authority is charging me and what you want to see is explained by this deferred tax component. And therefore, it introduces us to a new concept to say deferred tax exists only when the difference is temporary. So the reason I'm saying that is because now, if it's temporary, I don't need to explain. I can bulk up all the temporary difference into one line. But if the difference is not temporary, then I need to explain to the investors. So what I'm saying now is that as an investor, if I give you a deferred tax liability, you know that that's temporary. That thing is going to reverse in the future. If it's a liability, it's telling you that we're just going to pay more tax than what we are expecting. Oh, sorry. It means that what? If it's a liability, it means that, yes, in future, we're going to pay in actual tax than the one that I'll be seeing in what? In my financial statements. That's what it says. Because some of the tax is being deferred. But there are instances, which we're going to cover later on, when now this difference cannot be explained as a temporary one. Whatever I want, SARS does not want, or the tax authority don't want. They don't want this. Like, for instance, the tax authority will not allow you to contravene legislation put by the government and then give you a deduction for contravening that legislation. Otherwise, where's the pain? Where's the encouragement to avoid committing? So, for instance, SARS will then tell you what? Will then say, if it's a penalty that you pay to another government entity, you are not going to be deducted for that. It's not temporary, this thing. I will not change my mind. So this deduction that I'm denying now, it's permanently denied. This difference that we have is never going to be reconciled. It is final. So the investors will need to be explained. That is what we need to explain to the investors. Whereas all these temporary differences will just put into one line called deferred tax movement. So that is what I was trying to just get to. Does that make sense, Linda?
100% that storytelling. So that will be permanent differences which are unreconciled, basically.
Yes, 100%.
So you've got temporary and permanent differences. Thank you.
Sure. Masonobe?
I wanted to ask about the first 1,200. This channel that you did there at the bottom. Is this the resultant from the first calculation, which is the current financial year difference between that 8.7 and the 7.5?
So let me do this. Where is my? So is this amount? But
okay.
Yeah, because that's the one we are saying is future liability.
Oh, okay. Yeah. Now then I understand.
Sure. All right.
Sorry.
Yeah.
And then now when you're going at the bottom, the 1.2, the second 1.2, is this still that one from the deferred the second calculation from the deferred tax liability?
Yeah, because now remember that I'm saying this the expense. So I'm now saying this expense is now coming down here.
Okay.
Yeah, because this liability is what I'll pay in the future. But if I'm going to incur this in the future, I recognize the expense now because I know about it now. That's what accrual does. So I now recognize the expense and I add it up, not before tax because it's a tax expense. So I put it in this line item called tax expense for the year.
Okay.
So
what did you do with the first with the first difference, the 1.2? The first one that we touched, that temporary difference.
So this temporary difference, So what it just does is that it let us know that there is a difference this year, right?
Yes.
And then for us to know whether it's permanent or it's temporary, we check whether it's going to reverse in the future. Reverse, they will always work in opposite signs. So that's how we know it's a reversal. So if now when I did the difference here in these future years, I found that it's 1,000 only. So it will have meant that not all of this 1.2 is temporary. Some of it will not reverse. And that will be a problem that we refer to as a permanent difference.
Okay. Okay.
Yeah.
Thanks.
So we do this so that we check whether it's going to match 100%. But if it's not, let's say here is this 1.2, and then here it's 1,000. So that means I'll have 200 as permanent and this as temporary. So that means when I do this calculation here, I'll only bring the 1,000 as temporary. And the 200, I'll just need to tell my users about it. Does that make sense?
Yes, it does.
Sure.
I have a question.
Sure.
I see that the difference is as a result of the depreciation and the wear and tear. So what happens if we thought our useful life is going to be 5 years, but in the following year we realize we can use this more for more years than 5 years?
Mhm.
It then changes the whole thing, the whole calculation at the bottom, and I don't think this thing will match. Do we just adjust the deferred tax liability?
I know. So remember that if you change the manner of allocating depreciation, whether you increase or shorten the years, it just means that whatever is left will be different on an annual basis, but in overall, it will be what? It will be the same. Like for instance, if now you depreciate for 1 year and you're left with 64,000, if you change your years, it means that you might just be dividing it by 6, or you might just be dividing it by 5, but it does not change the total you're going to get to. So the total will still remain 64, but how you realize it on an annual basis might be different. And because here we're just saying all the years in the future, at the end of the day, they will add up to the 64,000.
Oh, okay.
Yeah, makes sense.
Yeah.
All right, sure. All right, so now this is the foundation. Sure.
Sorry.
Mhm.
Are we gonna have an early day? You might rather maybe close the class. Are you done? I think you're done.
I always desire that, but we're gonna get to one. We're gonna keep it to one. Yes.
Excited for here because when we got there, like we are done today. I'm like, yo, with my situation, I
But
would have been more excited.
we are done. So it's just like it's the dressings, like the cake is done. It's just now the decorations. You know the decorations we talk about the thing. Yes. Yeah.
Yeah, you know what? I'm actually grateful that today we are having these lessons because I think even during text, like we touched on that, and Madodonga will keep on saying, you know what? Remember the IAS 12. And I was thinking, will we ever get to IAS 12? But that's just a comment. I just want to understand,
Yes.
Rendani, with regards to the temporary differences.
Mhm.
Is it only the allowable expenses that give rise to the temporary differences? Because
Mhm.
if I remember, like during the time I was doing tax many years ago,
Mhm.
I don't know, like there was deferred tax implications on revaluations or like those items that will normally be on the other comprehensive income. So I
Yes,
just
yes.
want to confirm that, because if I remember, like we used to do like deferred tax on like revaluation of properties, revaluation on something. I don't know if maybe something that maybe I completely forgot.
Yeah, those are the icing on top that we're talking about. Yes, those we deal with them a little bit differently, because the standard makes a distinction between things that arise when you acquire an asset and things that arise after you've acquired the asset. And revaluation falls under things you acquired after acquiring the asset. But we're going to just touch on it. Interestingly, Saika and the team decided that those things are too complicated, so they removed them from the CTA syllabus. So you'll find that there's very little of it in your CTA notes, so that's not a mistake. That's not a mistake. What they've left it for is just for the land. So the only revaluation we're going to do is for the land. So that's what you can expect.
Okay, no, thank you.
Sure. All right. So now let's just now dress it up in accounting lingo so that
Are
when
you
you
done?
yes.
I want to ask that the effect of this journal that we prepared at the end, since it would come after you have gone through the preparation of the financial statements and the estimates for the actual tax obligation. That's when you have this journal. What would be its effect? Will you need will it update and change the financial position after you have come up with this journal?
Yes. Because this one was you're gonna have a new liability under your statement of financial position.
Yes.
Yes. Yeah. So that liability will then be, because liability reduces your your wealth.
Yes.
So you then reduce your wealth under retained income P&L. So that's what this expense will do. So on a net basis, then there will be what? There will be lower equity. So let's say you are already done, and this is your. So you've got your assets. Let's say it's 10,000. And let's say you've got your equity, and let's say it's 8, and you've got your liability, it's 2,000, right? So you want to recognize the deferred tax liability and reduce your equity. So at the end here you have what? Here you have lower equity. No, wait, what's happening? You have lower equity and higher liability. So that's what this will do to your financial statements.
It's okay. Thank you.
Sure. All right. So now, as I was saying, let's quickly dress it up. So we're just going to talk about some definitions in the standard, and we're going to do a break. So the definitions. So now, the standard then talks about what it calls a tax base. So in this case, it defines a tax base for assets. It defines a tax base for, so this is very interesting. So it's got what do you call this? Yeah, so let's call it, yeah, it's got assets. So these are assets that when you realize them, there is an expense. And there are some assets, when you realize them, they are income. So just stay with me here. So what do I mean here? Like if you think about a machine, when you have a machine and you recover the carrying amount, you end up with a depreciation expense. Do you agree? So something's like goes out when this asset has been realized. But if I've got a debtors balance, when I realize it, I receive what? I receive cash. When I've got interest receivable, when I receive it, I've got what? Cash. Does that make sense in terms of this? And even for liability, we've got expense liability and income liability. Expense liability could be the accrued rental. So an accrued rental, when I realize it, I have to just what? I have to just pay it. Then I've got income received in advance. And what do I do when I realize it? I've got revenue. So do you see how this works? So it's very interesting how the standard, it's like the way they thought about this, but they are not very explicit. But when you read it, you'll say, but wait, are they not repeating themselves? Or what kind of assets are they talking about here? Does this make sense? This when I'm saying an asset that it's like an income asset, an expense asset.
Yes, it's making sense.
All right, cool. So now the standard then says a tax base. It defines a tax base. But what is a tax base in simple terms? In simple terms, tax base is how the tax authority views the asset. That's what it is. How do the tax authority views the assets? So if we talk about a machine, we are saying that in future, when you use this machine you've acquired, the tax authority does what? Grants you wear and tear allowances. That's what we know. So in other words, when the tax authority look at an asset, how are they looking at it? Do you agree with me that the tax authority therefore views the machine as future deductions? If you tell the tax authority that I've got a machine, it's like they're saying, no, this one, there's an amount we're not going to tax in the future because this asset represent future deductions. Does that make sense? Does that logic make sense on when I say how the tax authority views the asset?
It does. I was thinking they view it as a liability because they're gonna lose money. They're gonna give you deductions against the income that they're getting.
Yeah. So and exactly that. So they are saying that this one is gonna cost us in the future because we have to give them these deductions. So and the way so the view, just to clarify, because I hear where you're coming from, the view is from the perspective of what? Of taxable income. So from a taxable income, so not from a tax liability, but from the taxable income, whatever they're going to tax, they are seeing a what? They are seeing future deductions. Agree?
100%.
Sure. Then now let's talk about the debtors receivable. So the debtors receivable, sometimes it's easier to go back to the accounting to say, wait, when this existed, what happened? So just talk to me, when will you have a data? And what kind of entries will you process? So because now this way process, your accounting and audit needs to come in. So how did this data get into the books? What was the transaction that occurred?
Revenue, credit revenue and debited data, if it's related to sales of products. And then other times, if you're loaning a person money, would be a bank and the debtor. So you would be debiting a debtor and crediting a bank. But the most one maybe that you are interested in is the one that arising from sale of products or whatever.
Great, agreed, 100%, right? But let me write both of them here because it's an interesting example. So arising from, say, loan to staff or something or another company. All right, so you've got this. So now, do you agree with me that based on what we said about the tax authority, when will the tax authority tax this data? When will the tax authority tax this data?
At the earliest of receipt of that revenue or accrual. So now this one would have been taxed when you are raising that data because you have not received the money.
Right. So in this case, the authority would have taxed the data, will have taxed the entity on invoice date when goods were sold to what? Was sold to debtor. Agreed? Then upon receipt, what will happen? Upon receipt of cash from debtor, what will happen?
You will not be taxed because you have already been taxed.
So this is, and this is why we had to go through the fundamentals of tax first, because the fundamentals of tax just paints this. You need to be comfortable with the small stuff. So the complex stuff, yeah, they do come, but for me, that's a second prize. The first prize is just to understand these fundamentals. So, okay, so now we've got this. So we've got this, this picture right here. Now, let's quickly then talk about this. So do you agree with me? Let's start with the machine. That the day the machine is acquired, the tax base of that machine will be the cost of the asset. Does that make sense? Because
Yes.
the cost will then be given in full as a deduction. Agreed?
No.
All right, so we've got 100. Let's go, sorry, we've got 80. Let's go back to our machine. We've got 80, which is the cost. Then we are saying in the current share, there's going to be a deduction of 20. And then in future, there's going to be a deduction of 60. So on the day you bought this asset, the tax authority said the tax base was 80 because they were going to give you in some time in the future the entire 80,000 as a deduction. And we are seeing it that 20 came in current year and 60 is going to come in later. But the entire 80 was the tax base of this asset.
Yes.
So that is what we mean. So that means the tax base will be changing year in, year out for an asset that has got what? That has got wear and tear allowances. Now, let's talk about the tax base of this data. So the tax base of the data, do you agree with me that the idea here is that if the tax authority love money so much, when they see you receiving money in future, they will forget that they've already taxed you. They will say, oh, we see you've received money. We want that money. But you will need to remind them that, oh, guys, you've already taxed me last year when I invoiced this client. And they'll say, oh, yes, we did. Sorry. But if that means that they will not tax you on the entire amount you're going to receive. So what will make the tax base? What will make the tax base for an asset that the tax authority will not be able to tax when it's recovered?
There will be no tax base. It's going to be zero because there are no future deductions.
Should be zero, yes.
I don't know, but let's think about process. Remember, process-wise. Let's say SARS, when they tax you, they ask for your bank statement. So when they get the bank statements, they are going to see the cash coming in. And they say, we want to tax this, right? But you then write them a note that, guys, no, you can tax that amount in the bank statement because you've already taxed it. So what will they therefore be giving you as a deduction against that amount on your bank statement?
Okay, so what you will say, the cost of my data or the balance of my data is, let's say, 20,000, because you have sold for, okay, let's say 50,000, and then you will say this amount has already been taxed.
Yeah.
Therefore, you will reduce it by the revenue of that 50,000 that has already been taxed. So it will be 50, the balance of the data minus the 50,000 of the revenue that has already been taxed and therefore becomes zero.
Yes, and this is why I love this class, because you guys can think through things, that you can think through this from a practical perspective, that the standard will just tell you to do this, but the logic is exactly that because to really implement that, they will not tax you again. They will have to give you a deduction of the amount you are going to receive. So the tax base now just ends up equaling the base or the balance you have. Does that make sense? Because when you receive that amount, then the tax authority will say, I want a receipt. You'll then say, no, you've already taxed me on this amount. So the amount I'm receiving, you should give me the entire amount as a deduction. So that means the amount for the tax base for a receivable, it is the amount that is recognized as the carrying amount. So the tax base will then be the carrying amount here. Does that make sense? So it's not zero, but it is the deduction, because when I receive the debtors, so this will be the balance of the debtors account. That will be its tax base. Questions? Does this make sense, this concept of a tax base?
Yes, it is. It is very nice the way you are putting it, because I think now you've got the tax base of the receivable, but is that amount going to be taxed in the future? Or are you going to be getting a deduction of that amount in the future? So that is another question that we are asking. Is it going to be taxed in the future? That's number one, or deductible in the future?
Yeah, yes, and that's how you think about it. So let's just now use the official terminology. So I've got the standard open. They say the tax base of an asset or a liability is the amount attributed to that asset for tax purposes. So that is their official definition. Very light. Then the tax base of an asset, it is the amount that will be deductible for tax purposes against any taxable benefit that will flow to the entity when it recovers the what? When it recovers the carrying amount of the asset. If those economic benefits are not going to be taxable, the tax base is equal to what? Is equals to the carrying amount. So this is that. And you know the standard is not always black and white, but that's what we're talking about here. Does that make sense?
100%.
Sure. So then please, as activity number 1, can you look at these little examples? You can look through them at break if your break is quite short, but otherwise just highlight them for now to say to look at later. Because I just want you to see. So it's very simple, but very useful.
Just leave the screen not projecting here because.
Oh, yes. All right, so it's about 1:15 now. Let's be back at 10:35, 20 minutes.
That's what we know. That's the break.
That's what we like.
Sounds like you were in prison. What was happening?
we were abused with the break.
10 minutes break.
All right.